In the grand theater of speculation, the most challenging and costly act is the final one, the exit. Any man can be brave enough to buy a stock, to place a bet on a future he believes in. But to know the precise correct moment to sell is an art, a science that has eluded most who have ever tried to play the game. The average trader is perpetually caught in a torturous limbo, torn between two equally destructive impulses. He either snatches a small profit too early, gripped by the fear that his meager gains will vanish, or he holds on to a winning position long past its zenith, paralyzed by a greedy hope, watching as a great paper fortune evaporates back into the unforgiving ether of the market. This universal failure to master the exit is the primary source of all speculative ruin. Jesse Livermore, the master speculator, viewed this problem not as luck or guesswork, but as a fundamental flaw in human psychology. He recognized that the amateur does not sell when the market tells him to, but when his emotions command him to. He sells out of fear or holds on out of hope. Livermore's career was a relentless quest to eliminate these treacherous human elements from his operations. He sought to replace emotional impulse with cold, calculated, and mechanically precise rules. For him, the perfect exit point was not a price guessed at the top, but a condition to be recognized, a signal from the market itself that the time for action had arrived. He understood that big money in speculation came from identifying a major trend and having the courage to ride it. But this courage was not blind stubbornness. It was intelligent patience, fortified by the knowledge that his system would provide, a clear, unambiguous signal when the trend was complete. He was not trying to capture the last eighth of a point, a folly that had cost traders millions. He focused only on capturing the great central body of the move, and, most critically, on keeping the profits he had made. To accomplish this, he developed and adhered to 3 foundational exit rules, a strategic trinity forming the defensive bedrock of his trading philosophy. For those committed to a deeper methodical study of the principles governing Livermore's legendary career, the essential text remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. It is a timeless book, offering profound insights into the unchanging nature of markets and men. The edition with Max Davidson's detailed chapter-by-chapter analysis translates this century-old wisdom for the modern reader, making its lessons more powerful and accessible. A link to this edition is provided in the description below. The first of Livermore's great exit rules was immediate and crucial for capital preservation. A trade must show a profit from the start or be abandoned. This was an ironclad law. When he initiated a position, it was at a critical pivotal point, a moment he believed was the inception of a major move. His entry tested his judgment. If the stock advanced, his judgment was confirmed. If it stagnated or declined, the market made it clear that his timing was wrong. He would not wait for a small initial loss to grow, nor hope for a reversal. He would exit immediately and without emotion. A position that does not feel right from the beginning is one that should not be held. The first loss is always the smallest and best loss. It is a small price for the invaluable information that one is on the wrong side of the market at that time. The average speculator does the opposite. A small initial loss triggers hope, often leading to the fatal impulse to average down. Buying more, believing the position improves, actually reinforces the error, compounding a mistake into a potentially catastrophic loss. Livermore saw this as ego, a refusal to admit a mistake. The professional speculator cannot afford such vanity. He must accept the market's verdict and act. His first duty is to protect his capital, and this rule is his most powerful line of defense. The second exit rule protected substantial profits accumulated during a major trend. It identified the exhaustion of a move. After a natural reaction, the stock must resume its advance and make a new high. If it failed, it was a definitive signal to sell. A healthy bull trend has a rhythm, upward thrusts followed by normal pullbacks on lighter volume. These reactions are not weakness, but moments for the market to consolidate before the next advance. Livermore watched them unfold without alarm. His focus was on what happened after the reaction. Did the stock rally with renewed vigor? Did it absorb profit-taking and attract fresh buying power? Could it push through its previous high and continue the trend? If yes, he held with confidence. If the rally was feeble, stalled below the previous peak, or failed to materialize, It was a clear danger signal. The upward force was spent, and the line of least resistance no longer upward. Remaining in the position risked giving back all profits. It was time to sell, not by guessing at the top, but because the market signaled the end of the advance. This rule transformed profit-taking from emotional fear to logical, signal-based action. The third exit rule was the most mechanical and unemotional. It was the ultimate non-negotiable line in the sand, the violation of a previous pivotal point. This confirmed a major trend reversal. In an upward trend, the low of the last natural reaction becomes a critical support, the lower pivotal point. As long as the price remained above it, the trend, while weakening, was not broken. But when the stock decisively broke, below that previous low, it was the market declaring that sellers had overwhelmed buyers, and the primary trend had turned from up to down. Livermore defined this mathematically. The stock had to pierce the old pivotal point by at least 3 points. This was not a minor fluctuation, but a confirmed breach of support. When this signal occurred, there was no hesitation, no hope. It was the absolute command to exit long positions and often to initiate a powerful short campaign. It was the point of no return. This rule, like the others, removed fallible human emotions from the decision. He did not need to feel bearish. The records and patterns told him he was. The mechanical trigger was his ultimate protection against overstaying a market and riding a winner back down to zero. The speculator's journey is often solitary, marked by the intense pressure of high-stakes decisions alone. It is easy to lose perspective, be swayed by crowd noise, or falter after setbacks. This is why our channel serves as a constant source of these timeless principles, a place to learn and recalibrate mindset. Committed speculators should subscribe and revisit these lessons for reinforcement and perspective. The wisdom of the markets is not confined to one individual. History is rich with masters who, while respecting risk like Livermore, developed unique styles, from Nicholas Darvas' mechanical box theory to Richard Wyckoff's volume spread analysis to Richard Dennis's turtle trading system. To explore this history, we launched a new channel dedicated to the world's greatest traders and investors. A link is provided in the description below. The practical benefit of these 3 exit rules for disciplined speculators is profound. They are not mere suggestions. They are a comprehensive system for survival and prosperity in an arena that preys on human weakness. Internalizing these principles moves a trader from emotional gambling to professional, probability-based operation. Winning lies not in brilliant predictions, but in managing one's fallibility. The first rule, exiting trades without immediate profit, shields against catastrophic loss. Most account blow-ups stem not from a market crash, but from holding a losing trade and letting a small loss become fatal. Livermore's rule prevents this, preserving capital and enforcing timing discipline. Buying a stock is not enough. One must be right about its timing. If it moves against you, timing is wrong. Exit, accept the market's feedback, and preserve capital. Trading becomes precise execution, not wishful thinking. The second rule, selling after a reaction fails to produce a new rally, converts paper profits into real money. Amateur traders often ride a stock to a paper profit only to give it all back because they lack a profit-taking system. Livermore's rule is logical and unemotional. Failure to make a new high after a pullback signals exhaustion. Selling on this signal is prudence, not fear, securing substantial gains rather than chasing every last cent. The third rule, violation of a previous pivotal point, is the final backstop, signaling a major trend reversal. Its practical benefit is immense, protecting the speculator from overstaying in a new bear market. The public is slow to recognize trend changes, buying dips until capital is gone. Livermore's mechanical rule prevents this. Breaking the previous reaction low is a command, forcing alignment with the new trend regardless of personal bullish sentiment. It allowed him to pivot from bull to bear, profiting from declines with the same skill as advances. Together, these rules form a symbiotic system of defense. The first protects against immediate error, the second protects accumulated profits, the third guards against systemic market changes. A disciplined trad may not catch every small move or sell at the absolute top, but he will survive. In speculation, survival is the prerequisite for success. Livermore's message is one of empowerment. The perfect exit point is not a mystical secret or luck. It is the product of disciplined observation and adherence to logical rules. The market provides all necessary signals if one has the wisdom to see them and courage to act. The greatest enemy of a speculator is human nature within, the voice of hope urging, hold on to a loser, and fear screaming, sell now at the first profit. Those who listen are lost. Livermore's rules silence these voices, externalizing decision-making to the objective reality of the ticker tape. The viewer internalizing this lesson transforms from gambler to professional, a student of conditions and a master of discipline. He will understand that his primary responsibility is not to be a hero, but to be a good businessman, and the first rule of any successful business is to protect its capital. The ideal exit point, therefore, is not defined by a price but by a state of mind. It is the moment when your system signals you to act, and you do so without hesitation or regret. It is the culmination of study, patience, and self-control. It is the recognition that on Wall Street, you are not rewarded for having intelligence, but for being right, and the only way to be consistently right is to follow a set of rules that guard you from being fatally wrong. This was Livermore's greatest secret, a secret that holds the key to lasting success for anyone willing to embrace it.